All right. How is everyone doing? Whatever time you are able to connect with the lesson, this is the LLQP exam training. This training is free, and I'm putting this together for our associates to make and enable them study on their own time and at their own schedule. Now, as we all know, the Canadian LLQP exam is comprises of four modules: life insurance, segregated funds, accident and sickness, and ethics. So we're going to go in this order. And today I am going to start with life insurance. And I will be taking 3 chapters in life insurance. And after the 3 chapters, I will take the question, the practice questions, practice tests associated to these 3 chapters. So without further ado, let's dive into it. Now, chapter 1 of life insurance talks about introduction to life insurance module and the risk of death. I'm going to go into sharing my screen while I go through this so that for some of you that want to follow along on the screen can do so as well. Now, we will be looking at the risk of death. Death is a risk which every one of us is exposed to. And the whole idea, the whole objective of life insurance is because life insurance can take care of some of the burdens that may arise from somebody dying. And what we do as life insurance agent is by helping our clients to understand the reality of this risk and their needs to address it. Okay, we come in, to let people see the reality of this risk and make them understand that, hey, you can do something about this. Okay, the probability that an individual will die at a specific period of age is called mortality rate. And for this mortality rate, there are historical data to support that. Okay, and many factors that influences the risk of an individual dying can include, remember, the person's age contributes to how and when somebody can die, right? Now, the younger you are, the less likelihood of you dying. Now, the person's gender. See, men do not live as long as women. Sorry about that. So men, yeah, and then our personal and family health. Again, don't forget the gender, the age, and also family health history. All this contribute to how long somebody live. Now, habits such as smoking, okay, contributes to one dying young, and then job and income level. You see, high people that earn high income is believed that they are able to live longer. Why? Because they're able to afford a quality life that enable them to live longer. Okay. Now, life insurance company, in assessing the risk of death when a person applies for life insurance, they collect all these factors, all this information, they put it into account to determine, okay, what is our risk here? Now, what risks are we exposed to? Is this person going to die young? Is this person going to live longer? Based on this information, okay? Also, the insurance company, they assign this individual into a group that consists of people of similar profile. That is, people that have um, family health history, paternities, but they are group, and this is how insurance company determine the premium you pay, the amount of risk they themselves are exposed to. Okay, the risk of death is based on life expectancy, right? Life expectancy means how long one is expected to live. And this is the average number of years a person within a certain group and of a certain age can expect to live. Okay, it takes into consideration, it takes into account the past mortality rate experience on the group which that person belongs to. Remember, we talked about after the insurance company collects the the information, then they are able to put people into various groups. And based on those groups, they are able to determine the mortality experience in those groups, okay? In Canada, at birth, male have the life expectancy of 79.8 years and female 84.2. And the probability of death, what is the probability of death? So we've looked at life expectancy, which is the risk of death based on life expectancy, probability of death. This is a likelihood that a person within a certain group of age or a certain is dying in a year. So now that these people are in these groups, now they have the statistics of people in these various groups, their probability of dying in a year and stuff like that. Now it assumes that the past mortality experience of that group to which that person belongs will hold through in the future. You see, nothing is based on empty statistics. Look, there are statistics collected that is helping the insurance company determine all these numbers and all these mortality rates. Now, at age 80, at age 30, a male has a little over 1% chance of death that year. Now, the probability of death increases with age. At age 85, a male has more than 8% chance of dying that year. Wow. Why? Because life expectancy, why is the probability of death increases with age? At age 85, a male has more than an 8% chance of dying that year. Wow. Life expectancy and probability of death statistics are combined for each unique and defined group of people and are often presented in a format. So this is a table, all these things we've discussed. You see, they put them in a format. You know, this is age, probability of death, now life expectancy. Okay, so look at that. And I'm sure this table is in your textbook. If you want to go into detail of it, you can do that. But from my experience, um, the question, no, the test is not going to ask you, and so in what is this? No, that's not going to happen. Okay, all right. So on that basis, let's move forward. An agent should educate a client on life insurance as well as probability of death and the need to mitigate the risk. Probability of death is used by an agent when doing an insurance needs analysis. Okay, life expectancy is a factor when developing a retirement savings plan or retirement income plan. And this is the reason why we do expert financial analysis for our clients. Why? Because we're able to ask them questions, and based on those answers, we're able to explain to them all this stuff. Okay, and then now you're studying for your exam. Don't worry, you're going to learn all these things from your field training. All right. Now let's move on. Forward. Moving forward, we move on to potential financial impact of death. You see, when death happens, it doesn't come with cookie candies or a gift to give. No, death causes pain. Death brings an impact on those individuals and families that they least expected. So what we do as an agent is that we are able to address the financial consequences of death when they access the client's needs analysis, just like I mentioned earlier. Okay, life insurance policies pay a sum of money called death benefit. You see, when we take life insurance, when the risk happens in death, in this case, the person dies, the life insurance payout is called death benefit. Okay? The life insurance payout, which is called death benefit, can be used, can help the family manage financial consequences. Okay? Such as paying off their mortgage if they have one, taking care of children's school fees, even feeding, paying rent, and even burial. Burial can be very, very expensive. Okay, so chapter 10 dives in deeper on this. So we're not going to spend too much time here right now. Now, the following are the examples of financial impact. Now, for instance, if a young father who is a primary income earner dies, the death benefit will be available for the remaining spouse to maybe pay for daycare, hire a caregiver, or if they have any debt like student loan, car loan, they can pay it off. They can also pay their creditors if they borrow money to do something, right? They can also replace the income. For example, if the person is earning 100,000, you see, per annum, this remaining spouse can take time off to grieve, you know, and then replace the income that the deceased spouse were to be bringing with this life insurance and death benefits. Okay, awesome, awesome. And also, life insurance death benefit can be used to pay off taxes because there are some taxes that will be triggered upon somebody's dying. All right. So yes, this life insurance can help to pay off those taxes and also create exit as well. Okay, business impact. Now, for those that own businesses and the key person happens to pass away, now the death benefit of the business partner may force the sale of the business as well as significant revenue could be lost, right? If there's no life insurance. But for a business owner that have life insurance, that death benefit can help the family keep the business without having to sell the business. Okay. Now, death benefit proceeds from life insurance can also be used to help minimize financial impact of death on the surviving family, yes, by providing money to pay caregiver. We've talked about this. Future reduction cost of deceased children, of course, create a legacy that is by paying an inheritance and give to charity. All right. Okay, okay. Now, moving on to risk management strategy. We all know that risk management is a choice, right? Or the choices a person make in regards to the risk that we faces. Now, there are different ways that we all can manage this risk. There are actually four of them. Number one, we can choose to avoid the risk. And number two, we can choose to reduce the risk. Number three, we can choose to retain the risk. And number four, we can choose to transfer the risk. Let's take a quick look at number one. Now, risk avoidance is a strategy an individual will use to avoid the situation or circumstances that exposes them to risk. For example, not smoking, right? To avoid the risk associated with smoking, such as dying young, according to them. All right. Now, another typical example is we are in an environment, especially if you are, in the western region of Canada, and when it snows, the road is really, really terrible. So you can avoid the risk of driving fast and then take it easy because you see some cars in the ditch, right? Yeah, so you avoid the risk by taking it easy, driving it slowly, take your time. You may get to your destination late, but at least you're taking it easy and stuff like that. Now, second one is risk reduction. This is a strategy used when risk cannot be entirely avoided. You see, an example of that is wearing seatbelt in order to reduce the risk associated with one injury, being injured if there were to be an accident. Okay? And the third one is risk retention. In this strategy, the individual accepts some or all of the risk. A person without life insurance retains all the financial risk of premature death, okay, waiting period, or all those kind of things. Now, the thing here is that some people, insurance is not for everybody, right? Some people already have so much money that they don't need life insurance. So these individuals can choose to retain the risk for themselves, to take care of it whenever it happens. Okay, that's the third one. And the third one is risk transfer. This is where somebody say, you know what, I can't handle this. And because I can't handle this, I'm going to be smart to transfer this risk to somebody else. And in return, for that person taking care of this risk, I'm going to be paying premium. That's typically what this life insurance is all about. When some or all of the risk is transferred, that is moved from one another to one person to another. Life insurance transfers financial risk from the individual to insurer in exchange for premium payment. Okay, for example, James and Mary are married. They are both concerned about having a car accident and the possibility of dying as a result. James adopts a risk avoidance strategy by choosing to take public transit instead of driving to work. Mary understands the risk of driving by deciding to keep driving to work. She adopts a risk retention strategy. So she also adopts risk reduction strategy by choosing a car with a high safety rating and wearing her seatbelt and obeying all traffic rules. When driving, Mary is aware of the financial impact that could result from car accident, so she purchased an automobile insurance and life insurance. This is a risk transfer strategy because if she does have a car accident, the insurance company assumes the financial liabilities. You see? So in this simple example here, we have seen the four different risk management strategy that has been described in this. And I hope we all get something fantastic from this chapter one. So we are moving on to chapter two. Isn't it fun? Isn't it interesting? You know, see, because when you're sitting down and you're thinking, should I start reading? Should I not? This thing is not that complicated. Come on, let's do this. And that's why I'm here to hold your hand shoulder to shoulder. So we get this done out of the way and start making money. Yeah, let's move on. Temporary insurance. In other words, called term insurance. Statistics Canada, life expectancy, and other elements of the life table Canada, all in all provinces except the province of Prince Edward Island. Okay, so give us statistics around. Okay, now what is temporary insurance? Temporary insurance means a life insurance policy is a contract. The two words contract and policy means the same thing, okay, and are used interchangeably. In this course, term life insurance is a contract that promises to pay a death benefit upon the death of the life insurance over a set period of life or to a specific age. Maybe could be for 1 year, could be for 5 years, could be for 10 years, 20 years, or up to age 65. Okay? Now, in other words, you can take temporary insurance for a specific period of years. The term insurance is typically used to cover or protect a specific need. For instance, a 25-year mortgage could be covered with a 25-year term policy such that by the time your policy is paid off, your policy is done, your mortgage is fully paid. Okay, if a person is insured by the policy dies during the term of the contract, the death benefit, that is the life insurance coverage, pays the beneficiary the policy. And if the person does not die during the term, the insurance policy expires and there is no refund of premium. Okay, so that is that one on temporary insurance. All right. Okay. So moving on, term insurance can be issued on this number of years. We've talked about that. A longer term have a higher premiums because the risk of death will increase over the 10 years. So now somebody take term insurance for 10 years, super cheap. You take for 15 years is more expensive than the 10 years. You take for 20 years is more expensive than the 15 years. And if you take for 30 years, of course, it's more expensive than the one you took for 20 years. Okay. There are age limits to term insurance. Term insurance can be issued to specific age such as age 60, 65, 70, or age 75. Again, depends on the insurance company. All right. Now, the older the age at which the policy ends, the higher the premium because the risk of death increases over that age. Yes, that is understandable. The older you get, the more expensive it is. Most insurance companies will not issue a temporary insurance policy past a specific age, around 70 or 80, at the most 80, due to high risk of death. All right. Now, policyholder versus life and life insured. Now, this is like two terms for us to know and understand. Okay. Now, who is a policyholder? A policyholder is an individual who owns the life insurance contract. This person is responsible for making all the decisions pertaining to the contract. Okay. Now, this is this section one. Point number one here is just telling us about permanent insurance and stuff like that. Okay. Now, you see who the policyholder is. Some decisions, such as who the beneficiary will be, are made when the contract is taken. So decisions may also be made while the contract is in force, such as changing the beneficiary or deciding to cancel the contract. So therefore, the life insured is a person whose life is insured by the contract. The policy holder may be the same person as the life insured, but they can also be a separate person. So we've looked at two major characters in life insurance policy right now. The policy holder, who is like the person, the policy owner and the life insured. So the policy owner is the one that makes decision about the policy, the one that owns the policy. The life insured is the person on whose life the policy was taken. Look at it here in this example. Joe owns a life insurance policy in which he is the life insured and his wife, B, is the beneficiary. If he dies, B receives the death benefits. Okay? James owns a life insurance policy in which his wife, Lillian, is the life insured and James is the beneficiary. If Lillian dies, James receives the death benefit. Okay, you can see that these two, in which he is the life insured. So these two are not the same. These two examples here are not the same. In the first one, Joe owns a life insurance policy in which he himself is the life insured and the wife is the beneficiary. So in this case, he is the policy owner and the life insured, and the wife is the beneficiary. But in the case of James, James took the policy on his wife, Lillian, and himself is the beneficiary. So if you watch crime Dateline, you see, the kind of stuff that happened in this second, this is where people take life insurance on somebody, and then a lot happens from there. Anyways, so I just say that just so in case you are tired and so you wake up a little bit. So yeah, these two. In the first one is the policy owner and the life insured, and the second one is the policy owner and the beneficiary, and then another is the life insured. Make sense? Yes. All right, let's move on. Now, the policyholder may also be called the life insured. I've explained that. Note that this is different from the life insured. Wait a minute. The policyholder may also be called the life insured. Note that this is different from the life insured. The policyholder is referred to as the insured because he or she has bought protection against the financial loss in the event of the death of the life insured. The life insured in a contract is usually one person. Death of that person triggers payments to the beneficiary. For example, Sandra would like to leave a legacy to her adult son, Tristan. And when she dies, so she bought 300,000 10-year term insurance policy on her own life, with Tristan named as the beneficiary. Sandra is both the policy owner and the life insured. Yes, we saw that earlier. Okay, Sandra works for ABC Limited and she is very important to the success of the business. ABC Limited bought a life insurance policy on Sandra's life. ABC Limited named itself as the beneficiary and they plan to use the death benefit to help them recruit and retain a replacement if Sandra were to die. You see, this is telling us that even an organization can take a life insurance policy on their key person. Okay. Now, we're moving on to section 2.2.1, single life policy. So now, most term insurance policies are single life policies, meaning that only one person is insured. Okay. Now, why is this said? Why are we saying single life? Is because we can also do a joint life policy, which we are going to see in the next point. Okay. And I want us to pay close attention to this and also note under what circumstances we use single life, joint life, and stuff like that, because questions come from this area in the exams. Okay. Now, single life policy means that only one person is insured, and the death benefit will only be paid if that person dies within the term of the policy. That is, if somebody takes term insurance, let's say, for example, 10 insurance for 10 years, it's only covered on that person's life. And if the person dies within that period of 10 years, the death benefit will be paid. And if the person doesn't die within that term of the policy, there will be no payment premium. And the next is joint first to die. So now, joint policy is an exception to the single life form of contract, such that policy insures two or more persons. Okay, this one covers more than one life. A joint contract usually names two people as the life insured. So when the contract is written as joint first to die, the death benefit is paid out to the named beneficiary when the first person dies, and the joint first to die policy is then terminated. Yeah. Okay. So this is like, let's say husband and wife. Okay, let's read the example. For example, Edwards and Helen marries and have a joint first to die contract, naming the surviving spouse as the beneficiary. If Edwards dies, Helen receives the death benefit. If Helen dies, Edward receives the death benefit. Simple. So this is people trying to take care of their destiny with both of them. Smart strategy, right? Some insurance company may offer the survivor the opportunity to continue the same level of coverage on his or her own life after life under a new policy. And what is the purpose of a joint first to die contract? Note all these purposes, very important. It provides the survivor with capital that money may be used to pay living expenses, pay debt, buy out a business interest. In short, it can be saved or used any way the surviving spouses wishes. Now, why should you pick a joint first to die contract? The contract usually has lower premium than having two separate policies or single life contract on the two life insurance. Now, joint first to die life insurance is also used to fund businesses buy or sell agreements as discussed in Chapter 8 Business Life Insurance. Now, combined insurance is a marketing concept and is different from joint life insurance. Okay, they're just telling us this, right? Okay, So now, basically, I want to just explain to us here that um, joint first to die is cheaper compared to individual, let's say husband and wife now taking 10-year insurance on each other. It will be more expensive than joint first to die. When they take joint first to die, the death of one person, it doesn't matter who, right? Now, and also it's also good for in some cases where people may have spouses that are not open to do this life insurance thing. So in that case, the wife can take joint policy first to die. If she dies first or the man dies, in that way the family is protected, head or tail. There's a win. The family will win, right? Awesome. So moving on to we've looked at joint first to die, and that is also being explained, right? And then the concept of combined insurance. See, with a combined life policy, two separate policies are purchased under a single contract, and the benefit is a reduced administration fee and a small discount on the premium. Two separate death benefits will be paid out, and at the time of death of each of the insured. So when the first person dies, the policy will pay out a death benefit and will continue to remain in effect for the surviving person. At the time the second person dies, the death benefit for the second person's life will be paid out and the policy will terminate. Example, Sue and Cindy are common law partners and they recently bought a house together with an outstanding mortgage of 250. While they can comfortably manage the mortgage payments with their combined incomes, if one of them were to die, the survivor will have a hard time making those mortgage payments. To ensure that the survivor will be able to keep the house, Sue and Cindy took a 250,000 10-year term joint first to die policy, naming the survivor as the beneficiary. If Sue dies, Cindy will receive the death benefit and can pay off the mortgage and vice versa. 4 years after Sue and Cindy bought their joint first to die policy, Sue was killed in a car accident and Cindy received 250,000 death benefit. Cindy and Sue adopted a baby 2 years before Sue's death, and Cindy wants to make sure the baby is provided for if she dies for health reasons. Cindy might find it difficult to buy life insurance with reasonable premiums. Luckily, their Green First to Die policy gives Cindy the option to continue the coverage of 250 as long as she exercises the option within 30 days of Sue's death. Okay, so now this is joint first to die typical policy, whereby the death of the first person triggers the payment of the death benefit. However, if and that was supposed to end the contract, end the policy. But if the surviving spouse wants to continue paying and keep that policy, he or she is free to do that and keep that policy. Okay, so now we are moving on to joint last to die. Now we've looked at joint first to die. Now we will be looking at joint last to die. Okay, when the contract is written as last to die, the death of the beneficiary, the death, the death benefit is paid when the last person dies. Thus, both life insured must die before the death benefit is paid to the beneficiary. Okay, this is not a typical everyday policy, and this is not for everybody. Okay, this is for estate preservation. Okay, for example, Edwards and Helen have a joint last to die contract, naming their son as the beneficiary. We all know that, you see, the estate, our real estate possessions and everything triggers a huge taxes when it flows from one generation to the next. What do I mean by that? See, take a case of husband and wife, for instance. When one of the spouses dies, the asset flows tax-free to the surviving spouse. It doesn't trigger any tax. But when the surviving spouse passes away and it's time for this asset to move to the next generation, which is now the children, there are going to be a huge taxes that will be triggered. And at this point, this is what this joint last to die insurance is typically designed to address, so that when the second surviving spouse passes away, this payment can then be used to pay all these estate taxes and all that, and preserve the estate within the family. That way, the children don't have to sell any aspect of the estate to pay taxes. They can draw from this joint last to die policy death benefit that is being paid to pay off all those taxes. Now let's go into the example that is given to us here in the textbook. If Edward dies, Helen receives no death benefits. Okay, so start from here. For example, Edwards and Helen have a joint last to die contract, naming their son as the beneficiary. Okay, now if Edwards dies, Helen receives no death benefit. Why? Because his joint last to die. Okay, now if Helen dies, Edwards received no benefit. After Edwards and Helen die, their beneficiaries receive the death benefit. This form of contract is used for estate planning, including creating an inheritance for the beneficiary and paying estate costs, such as income tax, particularly when the risk of being insured against does not arise until the death of the last person covered by the policy. It is tax liability that can arise upon the death of the second spouse, which was exactly what I just explained earlier. Okay, now because joint last to die policies pays the death benefit upon the death of the last surviving spouse, whose time of death could extend beyond the length of the term policy, these policies are more commonly used with permanent insurance. Yes. Now, if you want to take joint last to die, and the objective typically is preserving estates. Now, taking it for 10 years, taking it for 30 years, how do you know when the second person is going to die? Nobody knows, right? And if you take, say, joint last to die, and the last spouses survive or survive more than 30 years or more than 20 years, as the case may be, or as the term of the policy may be, what would then happen? It means there will be no policies at all. And that's why most people now resort to using permanent insurance to handle this, because with permanent insurance, you don't outlive it. It's there until the person passes away. Isn't that cool? All right, for example, this is a typical example for us here. Where is the example in my text? All right, here. Hamish and Elizabeth, both aged 55, bought a cottage 20 years ago, and it has appreciated significantly in value. They will love the cottage to pass to their children when they die, but they are worried about the income tax liabilities out there, which their accountant has advised them could be more than 100,000. Wow. Now, if you are coming across this for the first time, you may be wondering, what does that mean? What this typically means is that when you buy your house, let's say you buy your house in 2020, okay, and you bought it for 500,000. Now, by 2050, that house you bought 100,000 will no longer be 100,000. It will likely be 1.5. It could be 2 million. So because it's going to the next generation at this point, imagine your children or your beneficiary being faced with having to pay tax of 1.5 million. It's not a small something. Yes, I agree with you. Now, if Hamish dies first, his shares will go to Elizabeth and it will not trigger any capital gain because of the spousal rollover rules. Yes, that was what I said earlier. If asset flows to the surviving spouse, CRA is a very patient dog. Okay, don't, don't. Just get this. CRA is a very, very patient dog. So they're not going to come after anything. The assets will flow because of the rule of spousal rollover rules. No problem. They'll wait. However, when Elizabeth passes away, right, a joint last to die insurance policy will ensure that the estate has enough money to pay all these tax bills. Okay? All right. So death benefit. All insurance policies, not just them, pays a tax-free death benefit. And when the life insured dies, it is paid to the beneficiary. All right. Now, it's also true of all policies that the face amount of the policy is the amount of coverage purchased. What this means is that face amount is like if you take a policy of 500,000, that 500,000 is called face amount. Now, when the person passes away and that 500,000 is paid, and that payment is called death benefits. You got it? All right. If you don't get it, don't forget about it. Don't rewind it and make sure you get it. All right. Now, it is also true of all policies that the face amount of the policy is the amount of coverage purchased. However, term insurance may provide a decreasing death benefit called a decreasing term policy, an increasing death benefit called an increasing term policy, or a level death benefit called level death benefit. So there are three big words here that we need to unpack. Okay, there's level term, there's decreasing, and there is increasing. So now that we are going to dive into it, a level term policy has a set death benefit. It's level. If it's 500,000, it's going to be 500,000. It doesn't go down, it doesn't decrease, you get 500K. Your beneficiary gets 500K. This is the most common and straightforward form of term insurance. Okay, so now why pick a level term contract? A life insurance needs are not expected to change over the term of the policy. So the policy is easy to understand, is very straightforward, and stuff like that. Note, many people who purchase term insurance often do not take into consideration that their needs might change over the policy's term, and this means they may be underinsured. Now, this level of benefit, if you take policy for 100,000 or for 1,000,000, you're covered for 1,000,000. And when the risk does happen, your beneficiary gets that 1,000,000. But the thing is that over that period of that 10 years or 20 years, your needs may have increased that may result of that 1,000,000 not being enough, and vice versa. Okay, or your risk or your needs may have reduced either way. Okay, let's take a quick look at this example here. Brad borrowed 100,000 from his father, Stephen, to start a new business. Brad promised to pay it off in a lump sum in 5 years when Stephen plans to retire. Knowing that his father needs the money to be able to retire, Brad wants to make sure that he can repay the loan even if he dies. So Brad purchased a 5-year term policy with a level death benefit of 100,000. Okay, so now this is just level, right? So this guy borrowed money from his father, and he knows how much this means to his father. So he wants to be sure that if he himself, the son that borrowed money from the father, were to pass away first, he wants to be sure that even in death, he pays his father. Amazing. So he takes a term for 5 years policy on this 100,000. Okay, so that is level death benefit. Now, decreasing death term is a decreasing term policy has a death benefit that becomes smaller over a life of the policy. Okay, the premium on the decreasing term policy are lower than the premium on the level term policy. Now, insurance companies typically offer decreasing term insurance on a group basis, right? And why would you pick decreasing term policy? The policyholder has an obligation such as mortgage that will reduce over a period of time. All right. For example, now this decreasing term benefit, your debt benefit will be reducing as your obligation reduces. Here is an example for us. Ranjit and Alicia bought their first home in 2001 with 200,000 mortgage amortized to over 25 years. They bought a joint first to die 200,000 for 25 years, decreasing term insurance policy to ensure that if one of them dies, the other will be able to pay off the mortgage. Okay, so that is a typical decreasing debt benefit. Now, when you start your mortgage, the debt benefit will start at 200,000. But as your mortgage reduces, let's say you take this temporary for 25 years, maybe 10 years into this insurance of 25 years, the balance of the mortgage is 100,000 and the person passes away. The debt benefit will not be 200,000 again. The debt benefit will be 100,000. So that is why it is decreasing death benefit. You got it? If you don't forget it, don't forget about it. Rewind it, listen and watch it again, and make sure you get it. Okay? Yes, now you're laughing. I like it. I want you to laugh. I want you to smile. This is just a learning. It's not that big deal. Okay? All right. Moving on just apart onto increasing term policy. An increasing term policy has a death benefit that grows larger over a length of the policy. It keeps going. Okay, the increasing may occur over a year on a schedule such as every five years. The death benefit increases may be a set dollar amount or a percentage of the face amount. The total amount of the increasing may be limited to a maximum death benefit. So the premium of increasing is proportional to the increase in the death benefit. If the death benefit increases by 10%, so will the premium. Aha. So why pick an increasing term policy? The policyholder expects an obligation to increase over a length of the policy. For instance, he or she expects his or her debt or living expenses to increase in future, like inflation. All right. Now the policyholder will also pay a lower premium cost for an increasing term policy than by acquiring additional coverage in the future because he or she will be older. Okay. The benefit of an increasing term policy is that the death benefit increases even if the health of the insured declines. Thus, it provides the insured with more coverage in bracket protection in the future at the time when they may not qualify for life insurance coverage. In Canada, increasing term insurance is increasingly difficult to find. Yes, most insurance companies are no longer doing this anymore. And the same effect may be achieved by adding a rider to the policy. However, increasing term insurance is still offered in the United States. Yeah, but not. I don't think I've seen increasing term policy in recent times. You see, the whole essence of this increasing is also to curb inflation too, right? Because you see, if you may take a policy for 100,000 today, that 100,000 will not do in 10 years' time, in 20 years' time, what 100,000 will do today. But if you wage that policy with annual increase of 10%, you see that after 10 years, your 100,000 will be way more than 100,000 to take care of whatever inflation may be thrown at that moment at that time. And like we said, this increasing term policy is not common in Canada anymore, and I don't think I have seen any with any of our partners in recent times. All right, let's move on to 2.4, term insurance premium. Term insurance premium. So what's term insurance premium? All right, term insurance premium. All forms of life insurance, not just term, charges premium to the policyholder. Of course, you get a premium. Insurance companies are not Father Christmas, are they? Tell me if you know what. Tell me, because I love to go and meet them. The premium is the cost of the life insurance coverage for the life insured named in the policy. Okay, premiums can be paid monthly, quarterly, semi-annually, or annually. Yeah, so you can pay your premium monthly. That option is there. That flexibility is there. You can pay semi-annually, and you can also pay annually. You can pay by check or pre-authorized withdrawal directly from your account. Generally, term insurance premiums are leveled over the term with the exemption of increasing term policies. What does this mean? What this means is that in as much as you can pay your premium every month, or every 6 months, or every year, as you choose to, okay, despite the fact that it is term policy, your premium doesn't go up. Like if you take policy for 10 years, if you take policy for 20 years, your premium doesn't go up during the period of the term. It's leveled throughout, okay? Now, except for increasing term policy, now there might be provisions in the contract to state to what to stipulate to what extent, you understand, the policy will be increased. It could be 2% to 4%, depending. Okay. And I want us to know that provinces charges premium tax on the premium. It may be 2% to 4%. So now when you pay your premium, there is a tax on the premium. And you don't need to start worrying about that, because all that taxes have been calculated in the software before we tell you what your premium is going to be. Okay? You don't need to worry. Premiums are charged on a model factor when they are paid monthly, quarterly, or semi-annually. A model factor is charged by an insurance company. If you want to see more on that, we're going to get to it in section 4212. Okay? All right. You don't need to worry. We will get through all this together. Together. All right. How premiums are set. The premiums is determined by the mortality cost of the life insurance. Now, face amount, also by face amount. All right. For instance, if you take a face amount of 10 million as a face amount, you have a higher premium cost than somebody that takes for 100,000. Okay. And also your age. Premium differ. Your age also determines how much you pay. Your gender determines how much you pay. For instance, the men, they pay more. If a man and a woman, same age, takes policy of 1 million, the man is going to pay way more than the woman. Okay? All right. Okay. Premium differs between insurance companies, for an equivalent face amount. This is absolutely true. And that is why I love what we do here on the Experience. Why? Because we have so many partners, but we're able to compare prices and check them out and bring the best forward to our clients. Okay? And also your premium, we're going to be looking at mortality cost. Mortality costs approximate the insurance company's cost of paying out policy or death benefit. You see, the mortality cost these are the statistics the insurance company uses to know, okay, this year we're going to experience this X number of deaths from this age group, this bracket, that bracket. Those brackets that they put you to based on your categories at the beginning. Remember? Yeah. Now, the insured probability of death is dependent on risk factor, that is age, gender, and health. determined during the underwriting process. See, you know, too much. Like we determine it during the underwriting, they access all those, and then for those of us in a similar group, they put us high blood pressure, boom, diabetes, age. These guys, they are smart, right? Each year, insurance policies estimate their mortality cost by multiplying the face amount of the policy by the probability of death, blah, blah, blah. You see, all these things are things that happen behind the scene, all right? And because the insurance company, they have all this data, is coded into the software that we use to run the illustration. So we don't even worry ourselves. No, in the exam, they're not going to ask you, how does the insurance company comes out about the policy? No, no, no. There are softwares that does that, okay? And now expenses. An insurance company has many administrative expenses, of course. So now to pay from the revenue they earn, they pay the premiums that comes in as a revenue. Premiums are an important source of revenue to the insurance company. Some of the expenses include sales commissions. Of course, they pay us, the insurance brokers. Yes, we get paid. Then sometimes people ask me, hey, Joy, how does the insurance company get all these big, big commissions to pay us? You see, I'm adjusting my seat. Anyway, pass your exams as quickly as you can so that you won't be asking us that question again. Anyways, let's move it forward. Anyway, leave a comment in the comment section. You see, if you are enjoying this class so far. If you like this class and it's adding value, it's helping you, please leave a comment and please subscribe. Subscribe. It doesn't cost you anything. Click it now. Okay? Thank you for doing that. I appreciate it. And this is a way of you saying joy. Thank you. You see, I'm not charging for this effort. I just want all of us to grow together, learn together, build together. So click on that subscribe. All right. So yes, it's from the premium the insurance company pays on the brokers. The insurance company also invests the premium they collect. You see, the income they earn on those investment premium is used to offset expenses. They also invest, they don't keep the money in pool, right? And that's why when we do permanent insurance with people, we show you the fact sheets. We show you the rate of returns on those investments. Yeah. All right. Renewable versus non-renewable term insurance. Oh, this is a key one. Now, there are some term insurance that can be renewed and some that cannot be renewed. Now, what does that mean? You see, now you have term insurance for 20 years and you are in the 19th year of the term insurance. You are wondering, hey, after 1 year now, what if I live longer than 1 year? What am I going to do? Am I going to not get coverage? Blah, blah, blah. Don't worry. Here are your answers. Term insurance can be either renewable or non-renewable. A non-renewable term insurance is one that expires at the end of the term. Bam, bam, bam. Goodbye, teacher. Goodbye. Nothing more. But if the policyholder wants to continue covering, he or she will have to apply again and prove that he or she is insurable. Oh my God, and in good health. What if? What if the health is not as good as the beginning? It means she or she will not get insurance. But with a renewable term policy, the policy holder's right is to renew a guaranteed regardless of the health. What am I saying? Sorry, I don't know. I think I'm reading, but the thing is that if this policy have a renewable term policy embedded to it, the owner can renew this policy no matter their health condition. Okay. Now, the right to renew is usually limited to a certain age, e.g., blah blah blah, age 70. Okay. Premiums are higher for the renewable term than for non-renewable term. Now, why pick a term contract that have a renewable ability to it? There may be doubts about future insurability. For example, a client's family health history may indicate the likelihood of the future problems. You see, if in your family you know that at age so and so, there might be some health issues, and you really want to take temporary insurance and not permanent, then ensure that that temporary insurance have a renewable um, um, ability built into it, so that you can exercise that right when the time comes. Then not that, mark my words, the fact that it's renewable doesn't mean that it will renew at the price that you were paying before. No, it's going to renew at your attained age. The only benefit is that no matter your health condition, you're guaranteed to be insured. That is the only advantage. So you took this policy 20 years ago when you were 30. Now you are 50. My darling, you better sit down when you are getting the news of what your premium is going to be at this renewable age that you are, because it's gonna be small. For example, Henry bought 200,000 5-year renewable term life insurance policy on his own life when he was 30 years old. Ma'am, because of his great health at the time, he got the best rate possible. When he turned 35, he renewed the policy and his premium increased to reflect his age, 35, as specified by his original contract. When he was 38, Henry was diagnosed with cancer. And when Henry turned 40, he renewed his policy for another 5 years then. And again, the premiums increased, but only to recognize his increased age at the time of renewal. And his cancer diagnosis did not impact his premium, and he could not be denied continued coverage. So we get it? Thank you. Renewable provision, right? Now, the premium upon renewal may vary depending upon the policy provisions, right? Renewable with guaranteed rates. Okay, renewable with guaranteed rate. So this one gives you guarantee on the rates. All right? Okay. Do we want to take water break? No, let's finish chapter 2. Then we can take water break if we want. Oh, by the way, this is a recording. You don't even need to take water break. You can pause it and take your water break. But we will soon be done with chapter 2. Why not hang in there? Let's finish chapter 2. Then you can pause it and then take your water break. How about that? Okay. Now, renewable with guaranteed rate. While the policyholder of a renewable policy is guaranteed the right to renew the policy at the end of the term, the new premium will reflect the age of the life insured at renewal, of course. Yes, most policy provides a guaranteed schedule of renewal rates when the policy is first issued. For example, Trina purchased a 5-year renewable term insurance policy when she was 25. Okay, her policy offers the following guaranteed rates upon renewal. At 30, she paid this. At 35, 190. At 40, 230. 45. At 60, 610. 65, ineligible for renewal. Oh my God. Wow, amazing. Rita can rest assured that she can maintain her insurance coverage until age 65, as long as she is willing to pay the increased premium upon renewal. Okay. Re-entry term with adjustable rate. Re-entry term is a form of renewable policy, but is subject to 2 renewal rate schedule. A guaranteed renewal rate and a lower rate that is adjusted for a good health of the life insured. And what does this mean? Now, it guarantees renewal, but basis on the renewal premium on the health of the life insured. Wow. If the health of the life insured is better than when they first took out the policy, a lower premium is offered. And if the health of the life insured is deteriorated since the first since he first took out the policy, he still has the right to renew the policy, but the guaranteed renewal rates are higher than those for a renewal policy that does not have a re-entry provision. Wow. So in other words, if your health declines, you're going to pay more. How do one? Nobody knows tomorrow, right? Because the life insured does not have to provide evidence of insurability with guaranteed renewal policy, the insurance company is taking the risk of they continue to provide insurance coverage to someone whose health may have deteriorated over time. Yes. So for that, and for insurance company assuming this risk, premiums are usually higher than a renewable policy with a re-entry provision, which kind of makes sense, right? If they're giving you guarantee that, okay, this is what your premium is going to be regarding your health, then they're assuming those risks and there will be a higher premium to incentivize that. All right. Re-entry policies may be a good deal because the life insured retains some of the risk and the risk that his or her health may deteriorate by the time of the policy is up on renewal. Okay. Convertible term. Convertible term. Convertible term. Convertible term. Convertible term. Convertible term policy. All right, we're getting there. A convertible term insurance policy can be switched or converted from a term policy to a permanent life insurance policy without evidence of insurability. Thus, the life insured okay, sorry. For a minute, I'm like, I hope I'm recording. That would have been so painful. Anyways, let's move on. All right. A convertible term insurance policy can be switched or converted from a term insurance policy to a permanent life insurance policy without evidence of insurability. Thus, the life insured does not have to provide that he or she is in good health for the conversion. So the permanent life insurance policy ends with the death of the life insured. Okay. Permanent life insurance policy includes whole life insurance, then 100 and universal life. Okay. Now, what we're learning here is that if you have temporary insurance, there are some temporary insurance that gives you the ability to convert it to one of these permanent insurance. And what are these permanent insurance? We have 10 to 100, whole life, and universal life. Okay, good. You got it? Now, conversion times or age are specified in the insurance contract. The time you can convert to any of these permanent insurance are typically stipulated in the insurance contract. Why pick a convertible term contract? The reason could be to have the security of knowing that it can be converted to permanent insurance. You see, it comes with that gives you peace of mind, right? And also to be assured of a future death benefit. So in other words, you know that, okay, in the event that you outlive your term insurance, you will have the opportunity to convert it into a permanent insurance that will outlive you, right? And also when there is any doubt about future insurability, for example, Aya has learned that a rare medical condition runs in her family, and the condition usually does not develop until after the person reaches 30 years of age. Aya is not afflicted, but her teenage daughter Janet has a 25% chance of developing the condition. Aya is worried that this may prevent Juanette from being able to buy life insurance when she is older. So she bought a 200,000 renewable and convertible term policy on Juanette Life. And she plans to assign, that is, transfer ownership of that policy to Juanette when she is an adult. If Juanette does not develop the condition, she will still be able to convert the policy to 200,000 whole life, giving her access to lifetime insurance protection. Voila. Is it very simple? You can do that, okay? Now, incontestability and suicide provision. I need you to pay good attention to this. This will come out in the exams, okay? But it's not a big deal, nothing you can't handle. Now, incontestability and suicide provision. The permanent policy issued after conversion is considered an extension of the initial term policy. So the policyholder is exempted from a new contestability period and suicide exclusion. Now, the contestability period is a 2-year following the issue date of the policy. During this time, the insurance company can void a policy if it discovers a material error was made in the application. You get that? So contestability period is a 2-year period whereby an insurance company can void the policy if he discovered that there was a material error made in the application. And what could this material error be? It could be an error that will have affected whether the policy would have been issued or not. After the 2 years, a policy can be voided by the insurance company only if fraud has been committed by the policy owner. After 2 years, the insurance company cannot change anything again. They can't do anything. Except they prove that, okay, it was a fraud in the first place. The suicide exclusion period is also 2 years following the issue date of the original policy. If the life insured commits suicide during these 2 years, the insurance company can deny the death benefits. Suicide committed after 2 years suicide exclusion period is covered. Yes. So if somebody takes policy now, today, and they kill themselves within the next 2 years, the insurance company will not pay. But if they kill themselves after 2 years, the insurance company will pay. That is what the suicide exclusion means. And that's what's it called? Contestability is also 2 years. We've talked about that. Note that the contestability period and the suicide exclusion period applies to all forms of life insurance, not just convertible benefit. So this contestability period and suicide exclusion is applicable to all forms of life insurance, not just convertible policies. So term insurance, whole life, 10 to 100 universal, it's all applied to all. Okay. Attained age versus original age, 262. Yes, attained age versus original age. Okay, so when a policy is converted to permanent life premium that replaces the term premium may be based on the attained age of the life insured. The age of the life insured on his last, nearest, or next birthday, depending on the administrative policy of the insurance company. Now, when you are converting your policy to a permanent one, your premium is going to be based on your attained age or your nearest birthday or your next birthday, okay? The original age of the life insured, the age of the life insured when the policy was first issued. Let me take this again. What does it say? The original age of the life insured, that is the age of the life insured when the policy was said. That okay, it's explaining original age to us. Attained age, we'll see what attained age and the nearest birthday is. Okay, now premium for the permanent policy are less when the original age of the life insured is used. Example, Manuel bought a term policy, a term life policy issued, insurance policy on August 20th, 2020. And his date of birth is November 1st, 1986. His premium will be based on age 33. If attained age is based on the last birthday, his age will be 34. If attained age is based on the nearest birthday, his age will be 34. If attained age is based on his next birthday, Okay, his age will be 34 if attained age is based on his next birthday. Attained age conversion refers to the attained age of the insured at the time of the conversion to permanent. In case of original age conversion or retroactive conversion, a lump sum payment must be made when the policy is converted that brings the policyholder in line with what his cost would have been had he chosen the permanent policy in the first place. Wow. And this can be significantly freaking expensive. For example, Patrick was born on June 1st, 1966. His insurance company uses the nearest birthday when determining attained age. He bought 500,000 5-year renewable and convertible term insurance. And when his attained age was 45, the policy permits conversion at any time up until age 65. Patrick renewed the policy in 2016 and he decided to convert the policy on May 10, 2020. If this is an original age conversion, his permanent life insurance premium will be based on age 45. If this is attained age conversion, his permanent life insurance premium will be based on age 54. Yeah. And because his attained age on May 10, 2020 is based on the nearest birthday, which should be June 1, 2020, original age conversion result is lower premium for the permanent life insurance. However, the initial premium will be higher than premium for attained age convertible term policy due to the risk the insurance company is taking on if the original age conversion is exercised. Advantage and disadvantage of term life insurance. Okay, the advantage and disadvantages of term life insurance are summarized below. So now I want us to know that let's listen again and again on this attained age, nearest age, and birthday kind of thing so that we can master it very well, okay? Because there will be questions from here. Now, these advantages and disadvantages of term insurance. Let me go here for my textbook. Okay, so with term insurance, the premium is usually low initial cost in the early years of the policy, and the premiums for the term insurance will be lower than those of the permanent insurance, making it affordable for those that cannot afford permanent insurance, right? But the disadvantage is that premium coverages are not guaranteed beyond the term period. Yes. So at the end of the term, the premium will not be guaranteed again. Okay. Advantage of a premium are guaranteed over the term. Your premium doesn't go up, it remains the same. Renewable and convertible provisions can be used to extend the coverage. Term coverage can be customized to meet specific needs. Absolutely. All right. Excuse me. Now, premium increases as the life insured ages and can become prohibitive. It can become so expensive to the point that one won't be able to afford it. Coverage is usually not available past a certain age. For example, as we saw, age 70, 75, 85, 80 maximum, and most insurance companies will not insure anybody past age 80. Okay, policy is worthless at the end of the term. Yes. So when the end of the term arises, the policy is done, there will be no benefits to it again. So the person will either convert it if there's option for that, renew it if there's option for that, or they are left without coverages. Okay. In what aspect can we use our term insurance? As a general rule, term insurance should be used to protect against temporary risks that will end before the life insured reaches age 60 or 70. For risks that are expected to last until expectancy, until life expectancy, permanent insurance will be a more appropriate solution. Term insurance will be appropriate for a short-term risks that are known and expected to be short in duration. If there is a possibility that the risk may extend for a longer but not a permanent period of time, then the policyholder should consider a renewable term. Okay. Now, again, the risk that we can know that as for a specific period of time could be our mortgages, right? Now, decreasing risk these are risks that diminishes over time, e.g., mortgage insurance, limited cash flow. Now, where the policyholder may not have enough cash flow, enough money to put towards a permanent policy, and some individuals choose term insurance over permanent insurance and uses the difference in premium for investment purposes. Yes. You see, sometimes people don't have enough cash flow to put into permanent insurance. So instead of leaving themselves vulnerable, the wise thing to do is to take temporary insurance for that period. And then when their situations increases or improves, then they get to make permanent plan at that point. So that has brought us to the end of chapter 2. I actually wanted to finish chapter 3 and do the questions, but I'm going to stop here for now because I need to rush in for a meeting. But in the next video, I'll cover chapter 3 and we'll also cover the practice text for chapter 1, chapter 2, and chapter 3, all in the next video. Thank you very much for sticking around with me. If you have any question, any comment, don't forget to leave it in the comment section. And if we have brought value to you through this video, your way of telling us thank you is to please subscribe. Thanks. Bye for now.